What's up, you guys? Zoeb here from OneGlanceTrader.com, and in this video we'll be looking at three factors that will help us determine what strike price to pick when selling puts. And as you guys know, I like to sell options and use the wheel strategy, and the first part of the wheel strategy is selling puts when we don't have any shares of a particular underlying stock. And if you're brand new to this, click the link down below where there's a full playlist which walks you through the basics of options trading, an overall example of the wheel strategy, and now we're getting into the weeds of the wheel strategy in a bit more detail about selecting certain strike prices and the thought process that I go through when conducting the wheel strategy. And selecting a strike price for selling puts is the first part of that kind of wheel strategy. So if that sounds great, all I ask for in return is that you smash that like button, and don't forget to subscribe, because I'll be doing a lot more options videos. A lot of you guys have been asking me about more options videos, and I'll be showing you kind of live trades and kind of the stocks and stuff and stock picks that I'm looking at in terms of my options portfolio and options wheel strategy. So, like I said, there's kind of three parts really to look at this, and the first one is probably the most important one to a certain extent, is the option premium that you are going to collect. So, as we know, is when we sell the put, we are going to get some premium, i.e., a credit into our account, which is, as option sellers, this is how we look to make an income or to make a return on our portfolio by gaining that income and that premium. And there are kind of three different things that kind of affect, or the top three, I should say. There are other factors that will affect option premium, but these are the kind of main three things that will affect an options premium price, whether it's high or whether it's low. But at a very basic level, when you sell an option or sell a put, the closer you are to the current price of the underlying stock, the more premium there will be. Whether you're trading a week option or a month option, generally you will always see higher premium prices closer to what's called at the money, so at the current price of the stock. And again, the main kind of reason for that is that is that those kind of strike prices in and around the current price are most sensitive to kind of price movement, because it doesn't need to move that far down in this example, because we're selling puts, for your option to be classified as in the money. So the three things that kind of go into this, the first one is the number of days to expiration. So the thing you've got to look at is, are you selling a week option, a 2 week option, a month option, or even a longer term kind of option? And I can't help you determine that. It's the kind of trader style that you have, and it's all about the goals in terms of the income you want to get in, and how often you want to kind of manage trade. So for me personally, I trade weekly options. I have a weekly goal that I try to hit. I try to hit around $800 to $1,000 a week in terms of selling options. So weekly options seems to work well with me in terms of the effort I put in versus when I'm looking at kind of strike prices. And there is a Greek. So Greeks are tools that option traders use to help determine option prices and what impacts option prices. And then when we talk about time, we talk about the Greek called theta. And theta is basically the decline in the option price through the passage of time. So as you would imagine, the longer the expiration, the higher the theta, therefore the higher the premium. So that's basically how it works. So longer term options have more premium because there's more time until expiration for that option to be in or out of the money. So as time goes on, you can see when you look at options chains, and we'll look at that in a lot more detail as we do future videos. You can see what the theta is, which basically means, all else being equal, the price of the option will depreciate or decline by, if it, let's say it had 0.3, for example, it will expire by 30 cents a day, as an example. So that's one thing you got to take into account if you want more premium. One thing to consider is looking at longer term options. The second piece is the kind of price movements of the actual stock itself, and The Greek of that is called delta, which basically means that options price movement, or the options price movement for every dollar the stock moves up or down. So, for example, if a strike price has a delta of 0.6, so 60 cents. So what it's basically saying is if the current price, all else being equal, moves up or down by $1, the options price will increase or decrease by 60 cents. Now, what impacts this in terms of options pricing? As I said before, the closer you are to the current share price, the higher the delta is, and therefore the more changing in price movements up or down, depending on what happens to that underlying price, which is why that options closest to the money that have a high delta therefore have higher options premium. And for those who are starting out, and when we go into point 2 and point 3, it will start. You won't really, you'll care a lot about delta, but if you're looking at the different things, and I don't want to go into and jump into the second piece, you don't need to worry about delta as much, in my personal opinion. But if you're brand new and you're like a stock, you're selling a put and you don't want to be assigned, you really want to be looking at a delta of zero point 0.3 or below, which basically means for every dollar the price moves, the option price or the option premium price will go up or down by 30 cents. So as you go further out of the money, the smaller the delta will be, as kind of the name suggests. So if you're first starting, when you look at an options chain, you want to be looking at a 0.3 delta or below. Yeah, that generally is, gives you enough room, hopefully, that it's a low probability, or there's a 30% chance roughly that price will get to that strike price at the time of expiration. So you're about 70-ish% likely to be out the money, i.e. the option will be above your strike price. And then the last one is implied volatility. And the implied volatility is measured by Vega, which is the options price sensitivity to the changes in volatility of the stock. Now, what impacts volatility? So implied volatility, again, is what option sellers put onto the stock based on news, upcoming earnings, anything that is like external factors that are going around. So for example, if we take these meme stocks like AMC and GameStop, their implied volatility is very high because they are Wall Street bets driven. They could drop down at any time, they could go up at any time, so the implied volatility is quite high. Therefore the options premiums for AMC and GameStop are pretty high. Another example is Virgin Galactic, ticker symbol SPACE, SPCE. As at time of recording, I think next week Richard Branson and his crew are going to go up on a live manned mission into space. Now that there's a lot of hype around it, therefore the implied volatility is absolutely crazy for Virgin Galactic at the moment, and and the premiums look really, really good, but I don't want to get involved in it only because I like Space, I like Virgin Galactic as a company, but not at this time, because if there's a delay, for example, in the shuttle launch, or there's a problem or a mechanical fault or something, that stock price will drop, right? And I don't want to be holding a stock potentially at the kind of wrong price. So for me, I'm not getting involved, even though those premiums look really, really juicy and really, really exciting, and your return on investment looks really good. Again, I don't mind holding Virgin Galactic for the long term, but the volatility is a bit too high for my liking at this current point in time. So again, there are other things and other options Greeks that do affect the price, but these are kind of the main three, and the main three that people talk about when you uh, analyze stocks, or watch other options videos on YouTube. And again, so you need to take into account of these things impact the premium or the options price that you're going to receive when you sell your option. The next thing, in my personal view, which is one of the most important things and what I like to use, and is support and resistance, classical support and resistance. And I've got this example of Neo. So I do the wheel strategy on Neo. I've been doing it since February. And I've recently got called away, so all my shares. So I held about 700 shares in Neo at a cost basis of around 44, 45. And as you can see, what happened was is that price rocketed up to 54, and my call was around the 48 mark. So my shares got taken away, and as you can see, what's happened over the past week or so is that price has then dropped back down pretty much at my cost basis. So that's currently where we are at the moment. So I'm looking now on when and how to get back into actually and Neo stock, because I believe in Neo in the long term. And apologies, probably shouldn't mention who Neo are. They are a Chinese EV company. For those of you who don't know, similar to kind of the Tesla's China, effectively, from that perspective. And if you look at the long-term chart, we're in a good place in terms of upward growth momentum, a growth stock. Really good, a really good stock to look at. So when I look at this, and I look at this kind of situation for Neo, what I'm looking for is support and resistance. Now, I've got the hourly chart on because I like to do weekly options, and the hourly chart seems to be a good fit for me. But I will also check the 4-hour and the daily as well. So what I've done here is I've noted out this line here for support and resistance, and you can see here that we've got price came up to this level, formed a bit of resistance, pulled back, broke above, and now we've had 1, 2, 3 touches of this line. And as of yesterday, at kind of time of recording, um, you can see here that we've again touched, and we've had a long wick down, push back up. And for me, this is a good support and resistance level. And I ask myself the question is, would I want to buy Neo at that level? The answer to me is yes. I don't want to buy it at 54 or 55, whatever it is up here. I want to buy it when it drops down, and we'll go on to that piece in a second. So what I would do then is have a look at what is the option, what is the current price. The current price, again, at this time pre-market, is around 46, and we've got a thing of 44. So I'll be looking at the options chain expiring for next week at 44 or 43, because even though I'm doing the wheel strategy, I still don't want to be assigned the stock. So again, I'm probably going to look at slightly below that kind of support level, which then will act as kind of resistance level, similar to what's happened here. Hits this level, comes back up. So, I'll be looking at the 44, 43.50, 43 kind of strike price, see what those premiums are expiring, inside a week's time. And so the third point is what I look at. I look at the recovery upside. So what I always like to look for are stocks that have made highs and then have started to pull back. And as you can see here, it made a high, at the beginning of July, and it's taken this aggressive sell-off over here. And I don't want to be selling options when prices are at this high of 54. I don't want to be selling options at the 52 or the 50. Um, you know, I want to be looking at support and resistance zones. So another zone would be the kind of this level over here. Potentially, we've kind of got some resistance over here, which could have potentially found a support at the 48 mark. But this one here needs to be there. So at the time of when this price action was here, you can see there's a big distance between 55 and 54. And again, that is pretty much 10 points, around 20% difference there. The key thing is, if it's a stock that you like, you've just got to have patience. Neo could have continued rocketing. It could have continued rocketing, but I'm not trying to get into a stock or do the wheel strategy just because I like Neo. Doesn't mean I have to rush into things. I try find a level. Another level will form if price continues at this point. But now price is at this level over here. So again, there's 20% upside at this potential rate, which then strikes me that if I did get assigned, we're not at all-time highs, or at least 100, at least the 180-day highs are a lot. We're nowhere near those kind of levels, so therefore there's more chance for NEO to recover, and it doesn't even need to recover that much, depending on where I get assigned. Let's say I did get assigned at 43, and the price, is 42, and I know that the highs are up here. I don't need it to go that far for me to sell my call and get out of the stock and then replenish and do the wheel strategy again. So hopefully that kind of makes sense here. Is I'm looking for support and resistance, and I'm looking for where we're not at not all-time highs, 180-day highs and things like that. So again, in a short space of time, there's 20% recovery potential there as well. So if I did get assigned, there is still recovery, and from a time perspective for me to kind of get out of this wheel strategy trade on the call side. So to kind of summarize my kind of overall process, is step one, and I'll keep telling you guys this, is select a stock you do not mind holding. NEO, I do not mind holding stock of NEO. I think NEO is a $100 to $150 stock in the next 12 to 18 months, and it's currently trading at around 40, 47, 48. So for me, I don't mind holding it. Yes, I do want to get it as cheap as possible if I did get assigned, but I don't mind holding NEO. Next thing I like to look at is forget premium for a second. Forget premium is just look at a chart and just say, I want to hold NEO. What price would I want to hold NEO at? Or what price would I mind holding NEO below the current price it is today? So I'll set my levels on the daily, the 4-hour, and the hourly. And again, picking support and resistance and all that kind of good stuff. And then I'll zoom in on the hour, because I like to do kind of weekly options and have a look at, see where the most recent highs are. And in the previous slide we looked at, there's 20% before the where the previous high was. As long as I look at a minimum of 5% upside potential. So if we've had a run up, a sell off, let's say that sell off is at a minimum 5%, I'll look at, is there any natural support and resistance zones at that kind of level or slightly below? And then I'll be looking to sell an option at that piece. Then the last piece I look at is the premium, right? And that might seem counterintuitive because you're doing it to kind of make money ultimately, but I have to make sure it's a stock I like and it's a price I like. Then I'll look at the premium at my desired expiration. And if there's not enough premium, I'll either do two things. One, look at a longer expiration, so I've got higher theta, so there's more premium in there, or I'll pass it and I'll wait. Until the current price drops a bit further, closer, because as we said before, options, the premium gets higher the closer you are to the current price. So if we go back over here at the current price of $46, let's say the premium I'm getting is $50 per contract, and I wanted $80, I'll have to wait for price to drop further to maybe $45 to go get that 60, 70, $80 premium that I wanted. So that's the trade-off you got to do. If you're happy with the premium, you're happy with the return you're making, then you look to kind of place that trade. Because if worst case happens, if NEO drops to 30, not ideal, but it's a price where I purchased that I'm basing an assumption by the time expiration comes in, if I did get assigned, the price is not too far away from the price that I got assigned to. So it's really important looking at the charts and not just focusing on things like delta and picking a 0.3 delta. So if I go back to that conversation, is a 0.3 delta, I don't know where it is, I probably should have looked at it, at the current price might be at, I don't know, 41, for example. I don't know, depending on your expiration, a 0.3 delta, right? Your premium ain't going to be that great. But however, now that you've done some support and resistance analysis, so you're quite happy doing it at 44, which could be a 0.4 delta, 0.6, I don't really know, but to pick up some more options premium. So which is why I'd look at it, I look at the charts first and then check the premium after. And there are other things, the ways you can do this process by using like scanners, finding the stocks with the highest premium, and we'll go on to all of that stuff. We'll look at all of that stuff inside future videos. So I really hope that makes sense and it gives you food for thought in terms of what strike price to kind of pick. What I've got here, depending on if you're watching this, as soon as the video is launched or at some point inside the future, you'll see the full playlist, so you can see all my options videos and then the most relevant option video to kind of next step as part of this kind of process. So I really hope you guys enjoyed this video. Please like and subscribe, and I shall see you in the next video.